All right, we'll get started. Hello, everybody. Good evening. This is Prabhupada Dahal from Staggered Equity. Thank you for joining us this evening. And on a pretty short notice, actually. And I have Reshma with me. I don't know if the video is going to work with the background and stuff, but we're going to talk about why recession could be great for investors. So this is our series where every month we try to bring an interesting topic of interest or something that could be relevant in the real estate investment scape. So thanks for joining us. We're also recording this just for your information, and we will look forward to posting these. And over time, we hope to build a library of contents. Two things again I've said in the past webinars as well, but I know some of you are new here, so I'll repeat. We are here to learn and grow along with you. So we're not the only experts. We know that some of you are experienced as well. So we want to learn from you, and we want to share what we know, and kind of learn together and grow together. A second thing is, let's make this interactive. We will present topic that we have research on, and and occasionally we'll also bring subject matter specialists. But at the same time, we want this to be more interactive and not just one way, kind of lecture. With that, I think we'll get started on our topic of the day. So maybe I'll just go over what we're going to cover today. Briefly, we're going to give you some intro on what Staggered stands for, what we do, how we do it. And then we'll go right into the topic. Reshma will walk you through the reasons why recession could be great for real estate investors. I will also present a few asset classes that could be interesting in times like these, if you have not considered those. And then we'll open for any questions you might have. So Staggered was founded by Reshma and I here in Charlotte. We have, our vision is twofold, basically to provide affordable and standard housing. When we say standard, something that we would feel comfortable living in. And also to provide access to real estate investing to people who might otherwise may not have had that access or opportunity. So it could be, you hear a lot about real estate investors. They're big people, they're big names, but to get to them, to know them, to invest with them is always a challenge. We want to break that barrier and make it available for you all to come talk to us, and for us to talk to you. We have a very experienced network of realtors, property managers, marketing team, legal, everything, all the ingredients that's needed for a successful real estate investment. And so we want to leverage that and make opportunities for all of us to invest in real estate. What we do, we look at properties, single families, multifamilies, that provide steady income and have upside potential. And those are key ingredients that we're looking for at any time. We underwrite, we often make an offer after we do, kind of initial underwriting, we do due diligence, all the stuff that you may or may not know, but it's a lot involved, including syndication, for financing, we raise equity. We have a good network of banks and other lenders that we're engaged with and in conversation regularly. We manage properties, we try to maximize revenue, we optimize performance, all of this through minimizing the cost. And then we'll increase the value of the property. How we do that? We look for opportunities. Is it curb appeal? That's a problem. Is it maintenance? Is it how's the rate and compare? How are other things? We're looking for total returns to the investors, not just short term, lived and then that fades away. So timing is always important. So we refinance or sell to provide access to the capital back to the investors. We believe that the investors are in the best position to decide what they want to do with their money. And so as soon as we have an opportunity, we will repatriate their capital back to them. I have a question here, but I'm gonna, answer that here shortly. Let me just finish this intro. We purchase properties with value-add opportunities. We finance renovation, and then we bring rent to market. There's no rocket science here. Everybody does that, right? What sets us apart is our discipline, and we're very disciplined. We underwrite hundreds and hundreds of deals, but we only make offers on the ones that we truly believe are something that will add value to us and as fiduciary to our investors. Currently, we are at roughly 11.2. We're not big. We're just getting started. A little over a year now. And then we have approximately 300 units under management. Like I said, a lot of late nights and weekends behind the Excel spreadsheets to develop models, underwrite them, and then those only translate into, you can see a very small kind of reality. Here's a kind of snapshot of where our properties are. There are some single families, some multifamily, and such. I wanted to add, kind of, give you a bit of description of this latest addition to our portfolio. It's called Julia. It's north of Uptown. And see the pin there on the map. It's a 104-unit complex, and there's some 2.5 acres, I think, Reshma, of land that we plan to, make the best use out of. So we closed that in late 2022, just recently, a couple months ago. The renovation is underway. Pretty good metrics for the investors. It's a 3 to 5 years, and we're expecting its own kind of trajectory to meet the expectations of the investors, perhaps exceed, given what the rent market has done recently. This opportunity came to us through our network, actually. So if you're looking at published deals and Craigslist and all other, those are not the ones that we are after. We rely heavily on we have a marketing director who calls cold or goes out, hangs out with real estate, other professionals, and then we make outreach. And during that process, this deal came to us, and we executed on it and we closed it. With that, I'm going to pause here, maybe answer the question that is highly profitable and do not wish to get out in 3 to 5 time frame. Do we have the option to stay in as opposed to being bought out? Maybe I'll quickly answer that, Reshma, before I hand it over to you. So if we have a OEM that has an exit strategy, and to the extent that all our other metrics are met, we have to have a strategy when we go in. Now, if the majority of the JV ownership decides, and there are clauses where that can happen, and the management is in agreement to continue the ownership because the returns are good enough, that could be an option. But again, each asset is different. Some will have 3 years, some will have 5 years, some will have refi. I would like for you to look at individual deal and its OM closely, and before you sign the PPM, just look at it and see if that fits your need. Us, personally, we would like to remain flexible and just follow the kind of leads and advice of our investors. Having said that, there might be some restrictions on our ability to do that, given there will be multiple investors and different layers of rights and privileges. I hope I answered that. The other question, how much time do you spend in each property in analysis? I would say 10 seconds to days, even weeks. And 10 seconds because there are key metrics that we look at. If it doesn't fit that, it takes us 10 seconds to say no. And usually the ones we say no is a lot quicker than the ones that we say yes to. And part of that is because we want to go and take a look at the property. If there's no details, if there's no finance, if there's something that stands out as shady, if the marketing material, if the realtor brings deals that are not clear, crisp, to the level that it needs to be from a financial analysis perspective, we're out. So it doesn't take us too long to decide that. Whereas if it is a property or an asset that makes good sense. The fundamentals are there, the numbers are there. We spend, I'll give you an example. We're looking at a deal. It's a roughly 50 unit in South Charlotte, and it's been about 4 weeks now. And it's a negotiated deal, so we're back and forth, but we're constantly updating, upgrading, looking at opportunities, reviewing our models. We're asking our friends and others in the skip to make sure that our underwriting stance and the number makes sense. So I hope that answers your question. Reshma, to you.
All right. Hello, everyone. Thank you for being here today. I mean, I know you could be doing anything great and you chose to be here. So really, thank you very much for being here. Everybody pretty much today has been talking about the big word recession, right? And they're pretty curious to know like what we have been doing as real estate investors in recession time. Is this a good time to buy, invest? Should I just hold up my cash in the bank? What should we do? So I just wanted to provide a little bit of insight on what real estate investors, the one that are savvy enough or have been in the market for a while, does during time of recession. So, real estate is three-dimensional. I think that's the first thing I would tell anybody who wanted to invest in real estate. So real estate is not just appreciation. Yes, during the recession time, the value of your real estate might go down. But if you are buying right, which means if you're buying for cash flow, right? So your every month, the money that you get from your rentals will still be steady and will carry you forward even after the recession. So unlike stocks or any other investments like NFTs, and there's all kind of stuff today, is that the value, it's pretty much one dimensional, which means if the value of stock goes down, that's pretty much what you have and you're screwed. But in real estate, the value is through appreciation when the market goes up, and there's a cash flow when market is not as good as it is before, like 2 years ago, or there are people who invest in real estate just for depreciation and tax purposes. Like most of the people who joined the call today, whom I know, are six-figure earners, and tax is a big concern. So this is why real estate is a good investment for them, right? So in the time of recession, because of the interest rate hikes, not everybody is in the game who needs bank loan or already doesn't have a credibility. So what happens is we will have more access to the deals as price corrections goes on. So I'll give you an example, right? So during like 2020, 2021, what was happening was we look at a deal and they want us to put in a deposit amount of 3%, up to 3%, which is non-refundable, even before looking at the property. So that's how crazy the deal market was, right? And crazy to get the deal. But now that things have changed and moved to buyer's market versus seller's market, we now have time to do the due diligence. We have time to analyze, or ask for more documentation and analyze more deals. The sellers who would not really talk to the buyers or negotiate are now, basically coming to their knees and their grounds, and the price correction is happening. So recession is a good time to invest in real estate. Yes, if the deal is right, if you can negotiate the terms. The other big thing here is the interest rate, right? Because the interest rate is to a level where it will eat up your cash flow or affordability is low. What we do right now, we're analyzing a deal that's 42 units. What we have asked for is not to use the bank loan because we want to eliminate that factor of interest rate. We are doing seller financing. So when we do seller financing, we get to choose our interest rate, and it's not just for our benefit, but the seller's benefit as well, who's trying to retire. We are giving him the down payment that he wanted, that he wants to get out, and making him the bank and choosing our interest rate that will make us cash flow. So this is the way to get out of the interest rate circle and invest in real estate, right? So the other thing is assumable debt. So if, let's say, I have a property that has a debt, and like 2% or 4%, then the investors who's coming in or buying from me will have option to assume my debt and pay me the rest. So that way we're not overpaying in terms of interest rate. Our bank is not involved here. So current interest rate does not make any difference when we buy it. So these are a few strategies that we use when we buy real estate during recessions. And, and you can use it too. But investors really do not stop buying just because there's a recession. There's always creative financing that comes to picture. So, ask us any questions you have or any deals you have that you want us to analyze, and we are happy to do so. All
Hey,
right.
Rich, my quick question.
Yes.
And the seller financing, what's the rate of interest that the owner is willing to do the financing at?
Sorry, I could not see your name here. If you can introduce yourself.
It's Deepak.
Did you,
Deepak, is that you?
that's right. Yeah.
Okay.
Prab said that, right? I thought Prab said that already. My bad.
Hey, Deepak, nice to meet you. I don't know you, so nice to meet you virtually. So right now we are negotiating for 4%.
And okay, so the seller is obviously interested in doing it at 4% instead of the going rate of 6 to 7%, whatever that is. All right, that's awesome.
Yeah,
that's
it's
awesome.
9%.
Yeah, I mean, yeah, exactly. You're right.
9%. Yes.
And maybe I can add to that, Deepak. What the seller gets is a guarantee sale price, right? Now he can offload his asset and not have to worry about not getting the value. There's still uncertainty, and so that's a hurdle that meets their expectation. Now we haven't signed the deal.
Yeah. Yeah, that's a good point for bringing that up. So in that case, Prab, I mean, obviously we're getting a financing that is very appealing, but at the same time, as you mentioned, are we giving more valuation back to the seller because we're getting you know what I mean? Like it's like look at it from both sides.
Trade-off, right? I mean, if your return target is, say, I'll throw a number. If our return target is 20%, and to the extent that we can meet that target, I mean, we're okay giving them a little bit more to get the deal done. If the interest, it's like we could pay 9% to the bank and get the property for $10 million, or we could pay 4%, pay $12 million and still make 20% for our investors. To me,
I see what you're saying. Yep.
I think I mean, like, yes, we want the certainty of the interest rate. That's a big factor because that is the money going to somebody's pocket. But if we write it properly up front, it's locked in. So that is the part that's not volatile. Right?
No, I completely agree with you. I think over a period of time, if you're financing, 6 to 10 to $8 million at a 4%, this day and age,
yeah,
I mean that's a deal in itself, right?
No, I mean this is not done deal. It's not locked. Yes, no. That was our pitch. They didn't. They were like surprised, but they were not shocked. And but at the end of the day, that's what makes sense. And like, you want 6%, sure, this is the price you get. That's how we deal with this, right?
No, that's good.
6%, sure, we can give you 6%, but here's the offer price. You want 4% is good with you, here's the offer price. So for us, it's a level of kind of, optimized level of indifference.
Well, that makes sense. Thanks, guys.
Right. Sure. So since you sound like you have been in real estate, I assume there's another factor that comes into picture when we do seller financing versus bank loan is the fees. So bank fees, the appraisers, all the contingency we have that can be waived, and it can be closed sooner than later. So that's what makes it attractive to seller, not to mention the tax benefit they get in capital gains that gets spread over the time of amortization. So that's another benefit that seller gets. I've been asked, why would sellers do seller financing? And I'm like, I can tell you the answer all day. There's so many reasons why they would do it, depending on which stage they are in their life and the real estate journey they are in. So there's a lot of deals like that. It's not in MLS. It's not easily accessible. That's why people hesitate. But if you are somebody who's willing to put the work in for seller financing deals, they are there. So.
Yeah, that's awesome. That's great. Thank you for sharing that.
Sure, thank you. Thank you for your question. So I also wanted to mention that, recession is the time when most investors, right? Most people, day-to-day people will be more inclined to invest in real estate is because of the fact that, the market volatility would be so high that, if you're tracking S&P, it might make your head spin. So, but real estate is not that. It's a slow, you would see that, market is dipping, slowly coming up, or what's going on over there. And because you will get the cash flow. And if you intend to hold the property long term, if you buy right, buy right being you're not negative cash flow in, you know what the expenses you will have, what kind of capex you get, and the amount of rent growth that you will expect from that area. Not looking at last 2 years where inflation is crazy, but then looking at the last 10 years of history, let's say the population growth and everything, people tend to invest more in real estate than in stocks during recession. And like I mentioned before, for a lot of people, like we have investors who are doctors, engineers, who make more than $250,000 a year, they like investing in real estate is because of tax benefit. And also because when you invest in syndication, and this can be a whole new webinar altogether, is that your asset is protected. There's so much more details to it. So if you have any questions, do reach out. So, if you get sued or you are somebody who is in high risk zone, then if you invest in syndication deals through LLC, your asset is very well protected there. So that's another reason why real estate becomes more attractive to people. Right. But yeah, before investing, we'll, like everything else, keep your goals in mind. Like, what are you willing to do? What is your goal? Like, are you somebody who does very good in stocks and really want to put your money somewhere for 3 to 5 years until the market stabilize? Are you someone who's looking for cash flow and passive income? Or are you somebody who's trying to, save up money for your kids' college and you want it out in 3 to 5 years, right? So knowing your goals is always very important. And one thing I would say is a lot of people are investing in these deals. The vision that Prab had was to give opportunity to our community or people around us who doesn't know about real estate, doesn't want to be a landlord, give an opportunity for them to invest. But the first and foremost thing about real estate is location. So, do invest in a location that or do a little bit of research on the location. It is a very important factor in real estate. And always think about the cash flow that you're getting versus, only depending on the appreciation. And this is for everybody who invests on their own versus invest in syndication or any kind of real estate there. All right, so with that being said, I would pass the mic to Prab here so that he can go a little more deeper on asset classes in recession.
Thank you, Reshma. I see a question. We'll answer that at the end, if that's okay. So what are some of the asset-proof, strategies or investments, right? Reshma brings up a very good point. Yeah, it's your goals. What is your goal? Are you after building wealth and you don't need cash immediately for your, expenses or living style? Are you in, so those factors will affect what type of asset you choose, where you invest. But there are some assets that I would say at least a percent of your portfolio should be allocated to, and real estate being one. And then we're going to talk about a little bit of things that may not be mainstream. So bear with me. Some of you know my background is in real assets, specifically farmland and timberland. So I will be happy to, and I could go deep in the weeds on those, but I'll give you a very brief overview of what those asset classes look like, and their performance and what are the advantages. So very brief here, but I'm happy to chat with you because that's what I've been doing for almost 15 years now, is underwriting deals in that landscape, right? So the first one I'm going to talk about is the warehouse, though. And, one advantage of, warehouse investment is, Reshma mentioned location. Yes, that's right. But in warehouse, it may not be as important. As you know, when the recession hits, people start, kind of getting closer to the money, holding it back. But, they're not, but the e-commerce thing has still, like grown through the pandemic. There's been so much of, and so companies are looking for efficiency and they're not spending as much. The interest rate is high, so they're not making capex. So they're trying to find ways. And the warehouses could provide that opportunity where the companies could come in, rent. The spaces and warehouses are flexible to adapt to different purposes or subdivide. So that becomes kind of an advantage. Also, like I said, location agnostic. You could have warehouse in. You don't have to have in the downtown center or near like anything major, unlike population centers or apartments where you need certain amenities. So that could be one investment area that you could consider during recession. The other one I wanted to, I think it moved. Oh, all right. Let's move one more. Sorry about that. So farmland, right? If you look at farmland, it's a solid investment opportunity. If you look at, even if there's a downturn, people don't stop eating. And actually, a percentage spent in grocery and other essentials is much larger during downturn and recession. So when there is, special economic downturns, the food, beverage, other things, those prices remain same or even go up, and their demands do not decline. So if you look, the other benefit of something like farmland is they're not correlated to stocks and bonds. If you look at long run, just historic, 11, 12% consistent return from farmlands. And that is, pretty good considering how, less volatility there is. And if you are into that, like, I'm okay with a little less return, but I don't like the volatility. I don't know when I can exit. This could be a good strategy for you. There is, however, a higher entry barrier. And if you don't own, especially in the US, if you are not having a few hundred acres, it does not provide you with the scale to operate. You may not be kind of, in a position to actually operate. It's pretty involved if you look at some of the farmland. And most farmlands, especially in the US, are fragmented, actually globally, right? They're fragmented, they're owned by families, some abandoned, some still running. And there are operational, challenges and nuances. So it may not be for you. But I'll also talk to you about another option if you want to be in the farmland here shortly. The other asset class is timberland. Excellent vehicle. Believe it or not, money grows in tree, and that's because the trees that are being grown and you see all around you are being converted to your paper, to your homes, through 2x4s, 4x4s, your flooring, your everything, and especially in the US and most of the developed countries. Now you may have heard about CLTs, they're called cloth laminated timber, record-setting building heights. You can build, I think Norway has now 40-story building, all built with timber. So they are sturdy, they're very resilient, and they're environmentally friendly. Again, another asset class which is uncorrelated to stocks and bonds, strongly solid returns, low volatility. And the most important one, and you'll hear this again and again if you have not already, is how forests could provide solution to the climate change because they sequester carbon and convert carbon dioxide into basically biomass and or oxygen. So those are some advantages you'll hear more and more about. Challenges, again, operational challenge, scale, understanding of value drivers and markets. Where do you go? Just one thing is, just compare. You'll still find in South Carolina, North Carolina, timberland for $1,500, $2,000, $2,500 per acre. Still find that. If you start going bigger, maybe 500 acres, 1,000 acres, you'll still find that. And to manage those is not that difficult. So this will be an asset class we will probably start looking into a little deeper and bringing up for our potential investors. Because if you have a 500 acre, in next 10, 15 years, they'll continue to give cash flow. And, you can, take advantage of the appreciation of it. So I mentioned earlier how to get into these. It could be a challenge with, the scale, with the operability, operations, but there are other vehicles like TIMOs and AMOs, the Timberland Investment Management Organizations or Agriculture Investment Management. These are investment firms that will manage your assets, and they pool resources and investors, and then they buy timberland or agricultural land, and they'll have operations or they'll contract out, but there are plenty of those that do this. There are also public REITs, right? You may have heard of, Weyerhaeuser, Plum Creek, REITs like those, and other real, asset REITs that you can, kind of invest in. They're more readily kind of transacted, so your, funds are available, but they're not as resistant to market volatility as the other privately held, assets in the same asset class. So high net worth, if you are, several millions, you'll have a seat at the table with these TIMOs and REITs. You can negotiate better rates, options, just like any other deal where you can negotiate, and including the fees, because the investment managers do seek fees, and those fees can be negotiated. One thing I want to, in this space, wanted to talk to you about is you may have heard a lot on the ESG, environmental, social, and governance benefits, especially the carbon offset, net neutrality, climate change, those terms. And agroforestry is a way that is now, as of now, understood as the best option, also called natural climate solution, right? So naturally, how do we get into net zero? The very aggressive goals by European countries, and some areas in the US, especially coming from private sector and investors, they're trying to get into this game. So now is the best time to invest in agriculture and timber because you can capitalize on this growing demand for environmental and social benefits. I think with that, I'm going to stop and pause. I could go on forever with this asset class, but we'll answer some questions. I think, how do you find your deals or find out on seller finance? So I would encourage everybody, who has questions to either, kind of unmute themselves and ask, or just type it in the chat. But finding deals, that's one tricky part, and that's challenging part too. Because if we go and look at online postings, you will find out really quickly that those are not for us primarily. Most of the deals that come on Craigslist or through, these public posted real estate, media are deals that are for, they're not value add, they're already overpriced, they're already kind of, and it goes into the market, there's high competition usually. So we don't really look after, well, we do occasionally, but we're not always looking. The deals come to us through, contacts, through networking, and through just knowing the general area and assets. For example, I'll give you, if we know that a property has transacted in the last 3 to 4 years, it's likely to come up for either refinancing or, if it's an investment, most of the properties, they are where investors want to get out in 3 to 5 years, right? So we look at those properties and then we say like, okay, well, let's make an outreach, who owns this property? Where can we find the contacts? And then also through our network of real estate brokers and professionals. That's how we primarily find deals. We do meetings, we go to Greensboro, we try to focus within, 2 to 3 hours of Charlotte, just because that's where we feel comfortable. We can go look at the properties, make sure that, and we understand costs, expenses, and markets better. But, again, just driving around, talking to people. I think that is all the question I see on the board, and I'm going to pause for a second to see if there's any other follow-up that we need to address.
Hey, Prab, Deepak again. How do you guys project 15 to 17% on any, I know one of the slides mentioned plus or minus. How do we project that kind of profit earnings annually? What is the basis for that?
It's just based on a few things, right? First, you go and look at the current market. and current, what the property is doing, then you have, I mean, it's not a, it's when you do it, you have to be thoughtful and methodical, but in a nutshell is you take the inputs, then you look at the market, where is everybody else? Are there apartments nearby that are charging more? Why are they charging more? What do you have to do to the property to make sure that you get that type of rent? Does the economy support? If you're going to a neighborhood or an area where there's no jobs, no, a lot of unemployment, and you're expecting the the rent to increase by 20, 30%, that may not be a good idea, right? So we look at all of these inputs on what the job market looks like, local, like growth, how many, other competitions are there? Why is this property, is it below market? If it's not below market, we don't underwrite rent appreciation at all.
Yeah.
Because it doesn't make sense. So all of those combined, that's how we're looking. And we're not trying to hit like 17%, right? It just so happens that if it, and it could be 11%. I was just throwing that number out, and that deal that we did Gilead was an opportunity where, because it was in an area, it was going through that transition, right? If you look at Camp Lejeune, all the activity around NODA, where is the growth coming? It's coming next into that. So we feel comfortable in the next 3 to 5 years, kind of seeing that rent growth. And actually, we're already getting rent that we projected for next year, this year. So,
Yeah.
I mean, and Deepak, we've shared a few, property details. I mean, we are not aggressive by any means. We will be aggressive in our approach and outreach, but not on our underwriting. We try to be on the,
No, I know we've talked about it before.
Yeah.
So obviously, you're looking at the rents, you're looking at projected rents for the years to come. Another
Absolutely.
quick question, I think that came up before as well. How long do we plan on holding a property? And I know this is a decision with the GPs and stuff like that. But
Right.
is there a strategy as well to it to say, hey, typically we get a property, we get it all fixed up, we raise the rents, everybody's making money, we're making 13 to 15 to 14, whatever percentage it is, and now we're 3-year mark. And if we were to go and offload this property, maybe we'll make another sizable chunk of change. Versus no, we want to continue to hold on to it because we think it's going to continue to go up. And if that's the case, then how long do we continue to hold on to it?
So, I mean, like, fundamentally, if you look at just through cash flow, you're not making that strong return, right? I mean, if we're buying at 5% cap rate, for example, that's 5% return to our investment, right? And if you leverage it, which right now it's not leveraging, I would say, you're actually by borrowing, you're not leveraging it. It's the other way around. Because our investors may be okay with 5, 7, 6%, but the banks are charging 9, 10%. So that does not add value. So where do you get that money? That total return is through property appreciation, and it is by putting in it's a like kind of factory assembly at that point, right? You put capital, you put labor, and you produce a better property in year 3, 2, and that capital appreciation is what you're tapping into now. Granted, if we can refinance it and get our investment back, and then the balance makes 5%, 7%, that's an option we will consider any day. But like
so that would be an infinity rate of return if we can get our investment out based on the appreciation that we have, right? And make cash flow. So I think there was somebody else who was asking the similar question is, let's say in our Julia apartment today, we bought it, the rent was like super below market. When we bought 104 units, we bought 70% of the neighborhood. Because it's just a big chunk. 104 units is a big chunk of that neighborhood. Since it's not one standing building, it's small brick houses all over, right? So it's a lot of land. So what happens here is we dictate the market in terms of rent. So we are able to today from 600 to 700 average rent, we are now at 1,250 average rent, right? So if there's a good chances that after we rehab this property, the property value will double, right? It's like really showing now that it can double. So if we decide that we keep this property and whoever have invested with us today are agreeing to do so, then at the end of 3 years or 5 years, depending on where interest rate stands, we can refinance it, get all the money back for everybody who has invested in it, GP, LP, everyone, and keep the property, build on that land, add more units, and bring, more revenue that way. So, but if there are a few people who cannot be on the deal, then we can do a buyout option. So it will really depend on what kind of deal it is. So, but this, I think 104 units will be a very good example that we have vacant land to build. We have already pushed the rent so much because we bought the 70% of neighborhood. We were able to do a lot of there was a point of time where we'll have like 80% new tenant because the tenants who live there currently cannot, unfortunately, afford the rent or not the type of tenant we cater to, right? So that's
one of the things that
so it will really depend deal by deal.
Yeah, on that one, it was, one of the things is our capex is huge.
Yep.
And the condition of the property was not to the standard that we would like for anyone to live in.
Yeah.
And in that process, as the leases were becoming, were coming to end, as people were actually naturally leaving for one reason or the other, we're turning those around. I mean, I think 35 to 40,000 capex is what we spend on each unit. And with that type of capex, it becomes very desirable for other type of people who are happy to live in there.
Right. And we always say location, right? So Julia is in a spot where you can see uptown from the apartment, right? From your house. So it's so close to uptown. And it was just that pouch of uptown, which is not exactly great looking. And when you are able to do the capex, right? So otherwise, there are locations where you can make it like class A from class C, but rent will hit ceiling. But here, that's really not the case. So it really will depend on the deal and the location.
All right. So so at the time of the deal, there's no exit strategy per se.
No, we do.
Yeah, there is exit strategy. Yeah, there is exit strategy. For each deal, there's exit strategy.
Right. So we will have a 3 to 5 year exit. We will look at rent projection based on last 10 years, how much rent has increased, take the average of it and say, hey, child market has shown that every year we have 7% rent increase. So after 3 years, what would this rent increase would look like? With our capex, when we bring that rent up to market, what will that look like, right? So based on that, after 3 years, what are we able to sell it for? That's how we do the
Yeah.
calculation.
Got it. Okay.
One of the things that you bring up a very, very good point, though, Deepak. Maybe what we should do, Reshma, is, and I'm discussing brainstorming here, but what if somebody wants to be in that deal and is a majority, we could probably structure it. We'll have to talk to the lawyers, but we could probably structure it to say, for example, Deepak, you say, I got $5 million, and if there's a right deal, and I want to be, maybe majority stakeholder, I want to have an option of holding it for eternity if I choose so. Maybe we can structure it that way, right? With that type of, or it could be a deal where, Deepak comes and is primarily kind of the driver of the deal. We should consider that. We should think about those, maybe certain areas you'd be interested in that.
Yeah, I think.
Too.
Hey, Prab, this is Vinod.
Yes, hey, thanks for joining.
No worries. So 2 questions from my side. The question number 1 is, who does the feasibility study of all these things? Is it you guys do it, or you hire the external third party to do the feasibility study?
So it's a combination. It depends on what the property is. For example, if it's a property where we are very familiar with and are comfortable with, we will do it. So initially, the initial evaluation, right? If it requires phase 1 environment, those that we hand that to experts.
but specifically rent comps, for example. We have access to CoStar and other reports. You guys still hear me?
I think your voice went a little low, actually. I don't know. It's on my side only, or
How's it now?
it's good. Yeah, go ahead.
Okay, all right. Calls, so that's why. But no, if it's something that we're not comfortable underwriting, then we'll outsource. But if it's something that we're familiar with, we're confident underwriting, we'll underwrite ourselves. Now, having said that, we have a network of, I said, partners, filters all the time. We're downloading CoStar report, we're doing rent comps, things of that nature. So it's pretty thorough. And we also look at, general, like we consult contractors. I'll give you an example. One of the deals that we worked on, we actually, went there 3 times, like within a
Hey,
week.
Prab, it's really hard to understand you, man. You're,
I'm sorry.
Yeah, your voice is like,
Okay, hold on just a second. Let me.
Yeah, this is
change
better.
my
Yeah, this is
setting
better.
here, okay. How is it now?
much better.
Okay, sorry about that. Maybe I was too far from the microphone, but I don't know where I broke off. But basically, if it's something that we are comfortable with, we will underwrite it ourselves. We'll develop all the assumptions ourselves, but we'll check those against market. We bring experts in as needed. Like the last deal that we looked at, we wanted to get a better feel for what the rehab cost would be. So we brought a contractor and we said like, okay, well, these are the things we would like for this property to be changed. What would you quote us? And then they quoted us, and that became part of our underwriting. Does that make
and what
sense?
is your underwriting process? I mean, again, do you have again, the same question goes to, what are the key, maybe top 3 or 5 things you consider when you try to underwrite a project?
So it's our underwriting process goes like this. I mean, from deal identification to making an offer. I'll just walk you through briefly.
Mhm.
Is that okay?
Yeah.
Okay. So first, if we identify, we have a quick analyzer, right? Deal analyzer. It's a short form. We put in basic numbers. If somebody brings in, they say, hey, here's a property. The cash flow is, X, the expense is X, and the expense is shown at like 20%. I'm just giving some example of what the revenue is. And we see that their expenses is grossly underestimated. We know pretty quickly, right? And if they're asking like 5% cap rate at that, like, okay, well, this deal will not make sense. So that's the type that I said earlier, where we will probably spend 10 seconds. But if we believe that the numbers are making sense, that are within the kind of general squeeze limits, then we put it through a detailed underwriter analyzer, right? We have an Excel spreadsheet model built just for these type of deals. We put in all the assumptions, the current rents, the current expenses, and we have cash flows. Then based on the cash flow, it's a financial analysis. It's purely financial modeling. The only part where we have touch, feel, kind of, our soft side is location, because you can't fit that through the financial model other than through rents and comps. And just general desirability. Do we see upside? Do we see any other benefits of having that property? What's the curb appeal like? Those type of things.
Okay. And in your opinion, what is the minimum cap rate that you would like to see to make a deal in today's market?
Yeah. So, I mean, again, the cap rate, a lot of people go by cap rate. And I am quite honestly, I believe in just the total return. And, I have to have, if you're selling me a 3% cap rate, that's okay. If I believe that as soon as I get a hands on that, I could cut the cost by half, or do something drastically different than what you're doing to change that number. Right? So I really don't have a cap rate metric to evaluate a deal. Although I would like it, in today's market. So I mean, like if we're looking at it, a lot of the time you're seeing finally, 5 to above 5. Last year, you're seeing deals like 3 to 4%, and anything above that, cash buyers are buying, snapping it like a hot cake. And there are other big players in Charlotte, right? There's a lot of people or entities, companies that want Charlotte, including big names like Berkshire Hathaway.
Yeah.
So
So, and then my last question, I think we touched about it. So but just to clarify, so the return on investment 15 to 17 or 15 to 18%. That that is considering the possible appreciation and we selling out for the cap rate that we think. So considering that, that is 15 to 17. Am I correct?
yes, that's a total return. So
Okay.
that is your return of investment, basically.
Okay.
And
Yeah.
that is annual, right?
Yes, correct.
I want to have a really quick question. I know we only 7 minutes left. So piggyback off Vinod's question before, when you underwrite a property, I know you obviously keep some reserves for any unforeseen events when it comes to modifications, rehab costs,
Yep.
whatever.
Absolutely. We usually put 10 to 15% on our CapEx expense as like CapEx margin, because I have not seen a project that is completed in time or in budget. So we put
Right.
those. We have interest reserves. Banks require that, so we underwrite with those. And then we put some additional reserves depending on what the property looks like and our ability, because we do not want to default on any of those obligations.
Right. So I would imagine that, obviously it goes through a rigorous inspection as well.
Absolutely.
Making sure that, property's in good condition, because some of these, sometimes most of these properties are like 1950s or what have you. So the exteriors, interiors, all that sort of things, the electricals, whatnot, it's all put to test.
Plumbing, yep. Plumbing, electrical, environmental is a big one. We're looking at floods, we're looking at drainage.
So
all
all that
those.
is, all the deal is contingent upon, obviously, all that reports coming out, free and
Correct.
clear, all of that. Okay, yeah, that makes sense.
And
All right.
Yeah. One advantage of commercial real estate deals is, unlike, personal, and you may already know this, but you don't have a earnest money deposit that you would
Yeah.
lose, right? Within the due diligence period, you can walk for any or no reason. So
Yeah. No, it's good.
the only dead deal cost for us is our time and energy, and probably the opportunity cost of the due diligence money that we put in.
Absolutely.
So Prab, are you guys looking for investors or possibly GPs or something for this your new that Julia project?
Great question, but sadly, no. That has closed, and we were able to raise enough capital, both for rehab actually and for the purchase. But having said that, we will have other opportunities. We're actively negotiating some deals, so I would encourage you to just send a note to me or Reshma, or go to Staggered Equity and put in your email address, and we'll send out deals as they become available. And we'll have these monthly events. The best way, and as you know, is just having the relationship that way.
Actually, I would like to see your sample pro forma. Actually, if you have any deal which you have already closed, right? That's fine. But I would like to see your sample pro forma, and I would like to see what kind of due diligence has been put in that play in that pro forma.
Yeah, I mean, like, we can work on, if we have another deal, we can work
even if
together.
the deal which you have closed without, anyway, it is closed and you have all the investors and possibly the funds are, secured and everything's done. But just to get the clarity, right?
Absolutely. But see, those deals and those properties belong to the investors, and so I need to check with our legals on what we can share and what we can't. But I don't think it's a difficult thing to actually share our underwriting process for you.
Yeah. Just to see the clarity and the level of due diligence happens.
Yeah. No, that's important. Those are very important questions. And that is why we, try to talk to people, meet people, understand what their goals are. And for us, as we are growing, these are some of the questions, because if you ask hard questions, that makes us more disciplined, but also
I will give you a very simple, you know me, right? So I will give you simple. What is happening in the market is when somebody comes here, and that is where you need to differentiate yourself, right? Because I'll tell you, people will come and they say, guys, here is the high level the pro forma. They'll say, here is my cost of completion, which includes the the land acquisition, then total build cost, and then the design cost, the miscellaneous cost, and extra additional cost, blah blah blah. They'll say, here is the total capital pool required, and they will basically come up with a number and say that, okay, today's current cap rate is like say 5, and when we sell it for a cap rate of 4.25, okay,
Right.
boom, there you go. Here is your total return like XYZ%.
Right.
It doesn't, if it is that simple and easy, believe me, right? Many of us probably would be doing that, right? It's not
Right.
like that. And that is where I want to see how you differentiate yourself
Oh,
from any such like, and I would like to understand how depth and clarity you provide for people so that they can jump in and then they can be part of it.
No, absolutely. Our kind of philosophy is to be transparent to the investors, because end of the day, it's the investors' money. We're managers, and we have our fair share of involvement, but at the same time we are fiduciaries, and so keeping everybody transparent on our processes, our approach, that's what we do. And I think, to your point, that sets us apart is we're open, we're approachable, we are talking to you, we're sharing, we're actually learning. I'll tell you one example. One of the investments that we were, one of the investors wanted to put the money out of their IRA, right? And sure, it's real estate investment is treated same as the IRA. You could invest your IRA, personal, in real estate, and get it, take advantage of the tax benefits. But to move that money from that to this, I mean, we did not know, we didn't have experience, and that triggered us to learn a lot. We worked with the investor, we worked with other, like parties, and there were some intermediaries that were involved. So we learn every day. We would be, happy to kind of collaborate on any of your needs.
Yeah, no, that's good. Hey, I know it is like 1 minute left, but just for socializing. Hey, Deepak, you in Charlotte, buddy?
I am, and we should meet and discuss more, because like-minded people can generate ideas. So
Yeah,
I
do you
met with
mind?
Prab. Yeah.
You can share your contact, and then maybe Prab and I go for a long time, so we are part of this Carolina business. But if you don't mind sharing your contact, that would be great.
No, absolutely, absolutely. I'll actually, you know what? I'll have Prab send you my contact, or Prab, if you can send me the notes, I'll send him a direct message.
No, happy to do that.
Perfect.
Make the connection for you guys.
I mean, it's like, that is how it is, like-minded people just sit and talk, and these things doesn't happen like overnight, right?
Right. Oh, no.
And apart from the business, also, in my opinion, the mindset, the thought process also needs to match,
Yeah. Absolutely. It has to. It's a partnership, I wouldn't say religious marriage, but in a sense, it's a financial marriage.
Actually, and the financial marriage is more dangerous than the religious marriage.
That's true.
Because in religious marriage, there are a lot of families involved, there are a lot of emotions, but here, when it comes to like say financial marriage, it is cutthroat.
Yeah, good stuff.
But anyway, thanks, guys. I need to drop.
Thank you for your participation, and go online in the chat room. We put in our website as well as the Facebook page if you are a Facebook user. We're coming up, we're developing, we're building. Resma is doing a great job of social media and all that, and we want to be your kind of, we want to hear from you. We want to listen to you. We want to share our experiences, but listen to yours as well. So ping us anytime. And thank you so much. Unless anybody else has any question.
No, thanks, guys. Appreciate it. Reshma, Prab.
Yeah, thank you. Thank you, everyone. We
All right.
2 minutes over time. So
Thanks for your patience.
yeah, thank
Great
you for your
participation.
patience. Thank
Okay.
you.
Take care. We'll see you next month with
to
another
you guys
interesting
soon.
topic.
Yep.
Until then,
Thank you, guys.
goodbye.
Thank you, guys.